Hello guys, and glad to have you on board again today. This is one that we're gonna have to talk about. We've mentioned lots of these things in several cases in the past, but not enough in detail, so this is the reason why we're gonna go full deep into stagflation territory today, explain everything there is to know about this, and we kind of try making this one as quick as possible, but still expect a 20-minute long video at best. Okay, so first of all, what we need to talk about is the inflation perspective of the stagflation. But the thing is that all by itself, trying to explain the intrinsically complex nature of the current inflation that we have would take a 1 hour long video just all by itself. So I think it has been pretty well documented so far by some economists and good YouTubers out there. So instead of doubling down on doing the same content over and over again, I'll still suggest that it has been well covered already. So if you want to understand the complex nature of the current inflation pressures that we have, they're not just because of central banks' monetary policies. This is one of multiple factors that led us to where we are today. Supply chain issues and lots of other factors like that has driven us into inflation territory with very intrinsically complex mechanism behind that. So don't try to make things simple. Whoever is trying to explain the current inflation in a couple of sentences is probably just as stupid as just trying to summarize such a complex system in simple words. So it is complex by definition, and if you really want to dive deeper into this, it would require 1 hour long video. So this is something that we're not going to be doing today, but I suggest you do on some more economic oriented channels. So in here, what we do is that we pull this into more of a market oriented perspective. And what we care about is what that inflation is likely going to create as an economic factor, and how do we take those economic data into context for market behavior, and why so many people are having huge troubles forecasting the market now and making several mistakes because they apply different contexts and different situations by trying to copy-paste 2008 crash on top of current prices. Totally different structures, but we'll explain everything about it. So today's topic is to talk about the stagflation core mechanisms and understand what is ahead of us, how long are we expected to stay in stagflation, and so on. So we're going to look at economic models. As usual, models are no more than just pure vision of the human mind. So these don't explain everything, but they are partially correct because they explain well enough what happens, and that gives us a little hint on forecasting probabilities. So of course no one knows the future, it's just that there are far greater probabilities to follow suit by these models. So here it is. Let's get it started after this quick introduction. Okay, so the thing that we're going to have to talk about is that if we summarize the economic environment in classes, which is, like we said, no more than a model, so it's not perfect, but it's good enough. This is the way we would do it. Most people just pay attention to economic growth, and they see the world and economic world as a binary stuff. Either we are growing or we are not growing, and we are recessing. So it is not that simple, okay? That would be just looking at this thing in a simple x-axis vision, which is not at all complete stuff, though the best in here would be at least to add a y-axis. In that perspective, if we use the monetary inflation or deflation mechanism, so money growth and prices growth, so they can be growing or contracting as well, inflation and deflation, and we get an XY chart. So in that chart, what we can see in here is that, of course, that pulls out into 4 areas. We can either be inflating prices and creating growth, and in that perspective we have 1/4 of that chart. This is positive x and positive y axis, and we can get those 4 distinctive economical backgrounds. So considering it that way, of course, they are shaded gray areas when we are oscillating across 2 systems, which means we can hardly differentiate if we are stagflation or inflationary boom at the current stage, because we would be sitting right here. We have a slightly negative growth and we have high level of inflation, or at least higher above average. So that's the first thing that we're going to have to talk about. In this model, if we just pull out the data from the latest 50 years, what matters to me is that if we statistically look of how much time we spent in any of those areas, is there an offset? Is it just purely zero-centered or not? Then definitely it's not. What we can see is that over the latest 50 years or so, we have a trend toward higher chances of inflation rather than deflation, and we are producing growth more than we're destroying and contracting economies. So there is an offset into this thing, which is in inflation territory with a growth perspective. So we're spending most of our time in inflationary boom. This is due to the current macro cycle behavior, which means these are things that can rotate each and every 80 to 90 years. So it takes freaking long. So we'll just make a quick assessment in here, even if these things are about to change. This is on a totally different scale to the things that we're going to be talking about today. What's next to come for the next couple of years? Though in that perspective, we'll make that assumption that we're still in the same model. And though in that perspective, the center of gravity is this, and we can see that model as kind of a distribution across the mean or the center of gravity. So this would be kind of a circular area around that center of gravity, which is shifted to the right and the top area of the chart. And in that perspective, we can apply the general speculative behavior of standard distribution. And though in that perspective, we will get standard deviation above the mean or center of gravity. So the probabilities of going out of these standard deviations are very rare, of course, but this is where we can find Japanese 1990s, Europe 30s, and the 1970s stagflation extreme, and of course, the USA deflationary boom. So in this environment, what we can see is that the opportunity we have to get into extreme territory are very rare, because it happened in the past and probably will be in the future as well, but the odds are very low. So that's the first thing we know. The probability of getting to extreme stagflation, depression, deflationary boom, or inflationary boom is by definition rare. Most of the time, we oscillate across the center of gravity. So these are assessing the current forces. Okay, are we getting back to the mean or are we getting out of the mean? Currently, of course, that would be kind of plotting a vector. So we were definitely going from the mean. Over the past years, we did have positive growth. It wasn't that crazily good. It was limited growth within a high level of inflation, or a moderate level of inflation. We're pretty much starting from somewhere in here. So we were not at the mean, but close to. And now over the course of the latest 2 years, and specifically post-COVID, then we have drastically shifted toward stagflation territory. That's what I've mentioned like a couple of years ago, that the nature of supply chain disruptions that we will have back from COVID and the tremendous amount of money that was pulled out in the economy through monetary injections will definitely find its way to inflationary pressure. I never said that printing money will cause inflation. It's not that simple, but it inevitably would have rippling effects down the road. And here we are today. We have that inflation, and immediately afterwards, the supply chain bottlenecks have created growth to be deteriorated to the point that we're actually now in a technical recession. Technical though, because we're going to look at the charts and we're not more than that. But right now what we have is that if we consider this as a vector, because of course over time we move across this board, and we have just now gone from something that was close to the center of gravity, and we're pretty much right now getting away from it with a significant kind of momentum, meaning that the force of this vector is quite significant. So the thing is that on top of this vector's direction and force, we can also say that we've changed the economic environment. We're no longer in inflationary boom, that's for certainty, and we're entering stagflation territory. Of course, the dumbers are generally doing the same old thing. They take on what happens and they keep on forecasting it like forever. So in that perspective, 5 years from now, we'll be in extreme stagflation, we'll all die, things like that, okay? But that's the thing we can tell. Luckily, that's very much less likely what's going to happen, because like we stated, the further we go away from the mean, the less likely the probability of sustaining it will be. So forecasting now extreme stagflation territory and comparing current economics with the ones in the 1970s makes no sense. This is where the current vector's position is headed to, but it's going to take far further deteriorations to actually get there, and the probability of having a linear projections of our vector is actually really unlikely. If you look at what this chart looks like over time, pulling out all the historical data, you would see that this much more likely look like loops. We're mostly looping around areas and oscillating across those different places. And we're, of course, generally, just like the normal distribution does, getting it more closer to the center of gravity. Okay, so that's one thing very important to understand. This is a dynamic chart, but currently we're in stagflation. What we need to understand is that when we are settled into an area, there are some mechanics that puts in play. Okay, and when we're in one area, they are factors, feedback loops, automatic feedback loops that tend to push us toward extreme, but there will be opposite forces trying to normalize these things. And these forces will battle, and generally they cause these numbers to kind of loop around an area before eventually reversing. Okay, so that's the way the market behave. There's one thing that we know as very less likely, though, is that when we enter an area, there's a very less likely chance to change the area. So when I see some people forecasting the 2008 crash back into the current prices because there are similarities in the behaviors of prices, boy, that makes no sense. 2008 was a depression type of economy in which we had deflation. Today we have an inflation problem. So pulling out 2008 prices on top of today's price action is absolute nonsense. It's like copy-pasting on two totally different way of behaving economics. So it makes no sense, okay? Don't do that. We're in stagflation today, nothing close to depression, and unless this changes, the probability having our current vector going right out there is close to zero. So copy-pasting 2008, probabilities of seeing that really happening in the real world, close to zero. It's not zero because nothing is impossible, but very close to. Okay, so that's for the basics, understanding how these things go and the dynamics. Worldwide economies have all shifted towards stagflation now, at least major economies. China is still far away from this, but in that perspective, this is where we are now. We're headed into stagflation territory, and there are, though, stagflation pressures on every worldwide economy. What does that mean? Well, that means that if we look at these things, sorry guys, this is in French, but this is easy to translate. So there are two sides in this equation, the x-axis, which is growth, and in here we are in stagflation territory. We're in growth contraction, negative growth, so we're talking about recessive kind of behaviors, and recessions mechanisms are behaved into three interacting properties: the lowering demand, the rising unemployment levels, and the deteriorating GDP, though, because combining these two can only create lower GDP outputs. So in that perspective, that's for the recessive end, meaning that the lower GDP is caused by the increase in unemployment and the lowering demand, because the lesser people participate in the labor forces, the less money they have to spend, so the demand goes down, and this automatically fuels the negative feedback loop that lowers GDP outputs. On the other hand, you've got higher inflation, which is lowering demand due to the higher cost of goods that limits the ability for people to buy these such goods. So in that perspective, this is really the negative forces. The rising unemployment and rising inflation, even though further down the road weakens the demand, which is weakening the GDP. Okay, so this is what this is all about. This is really simple to understand, but these are the feedback loops that push us toward the boundaries of our system. Remember that most of our time we oscillate across the center of gravity and we rarely get to the extreme, but these are the forces that lead us there when we do this. So this is what we need to take out from the 1970s models and so on, because this is exactly what pushed us back into the 1980s. Now, if we want to go one step further, we're going to have to study in deeper perspective what are the stagflation mechanisms, what are the ones that we can exploit, and know how they work, so that we know how the opposite forces will fight against them. Because they're definitely opposite forces as well, the ones that push us right back to the mean. Not to mention them, the Fed is one of these forces. So there is a very good paper in here. I'll try to eventually put the link in the description, otherwise you will easily find this, which is very greatly explained in here, okay? Though lots of characteristics of stagflation, one that I really particularly like is the fact that stagflation is difficult for policymakers, meaning that specifically the central banks may eventually try to play around interest rate to reduce inflation or cut interest rate to reduce unemployment, but they can tackle both inflation and unemployment at the same time. We'll see all about that in greater detail as well in the further things. Though that's what we do. Deflation pushes the vector on all real GDP to price mechanics, though inflation, it pushes the vector into the top left direction. So this is exactly what we've talked before, okay? The general causes for stagflation, reason why I've seen this thing coming for a couple of years, because we had serious supply shocks. This is one of the many causes that pushed us into the moderate degree of stagflation we're currently in now, because we're going to have to talk about it very clearly. So many folks now think that we are in stagflation, though we already have the intrinsic feedback loops that will automatically feel these things, and we're already fucked. We're headed into 1970s. like we said, it is very unlikely because for many reasons we're far away from stagflation dangerous levels. We're just entering stagflation. So we've changed the narrative and we've changed the background forces of the economy. As now growth has started to deteriorate, we do not necessarily are in a recessive environment. We might eventually have it. The only negative feedback loop that we're starting to see now is around inflation. And it's still not yet very advanced, meaning that we might see the first automatically feeding loops of inflation pulling them places in the market. And this is the reason why the Fed is going so aggressive against inflation now. They may start to disrupt growth, which may even start to sparkle the first growth problem related of stagflation environment. But the reality is that what we are in now is a moderate stagflation. We have early signs of stagflation behaviors, but that doesn't mean we can't fight against them, okay? What really is important for you to understand in here is that many people right now talk about stagflation because of the rise in inflation and the fall in growth rate, but this is what we have. We are actually lost the previous state of the economy, which was an inflationary boom. We're now out of this. So this is more like we've terminated the previous cycle without necessarily meaning that the new one we're entering on is going to be extreme. And that is the big problem people see right now that I disagree entirely with. It is the fact that we are in a moderate stagflation, but this is far less damaging than having higher inflation and negative growth, which we still don't have at the moment, okay? But it still represents a deterioration in the trade-off between unemployment and inflation. What that means purely and simply is that this is the mechanics that we need to take advantage of. This is the fact that stagflation, even if it's moderate, is anyhow and anyway already shifting the Phillips curve because we're out of the previous economic cycle era and we're into a new one. Lots of things have changed and it immediately shifts the Phillips curve. The Phillips curve is the economic model that economists use to see and model the relationship there is between inflation and unemployment. Because remember that in our equation, we've put in an XY axis, but there is basically a Z in here, which would be unemployment. This is another factor in our equation, okay? So of course, unemployment can't be negative, okay? It's just a fraction of people who are not working, but in that perspective, there's a clear relationship. And the first thing that stagflation does is shifting that curve. So if we had that Z axis, we would have to understand that there will anyway going to have to be a consequences around unemployment, because now that we have entered these stagflation environments, the Phillips curves have already started shifting, and it's doing it very quickly. What that means is that to sustain the equivalent level of unemployment in a stagflation environment, it will require a higher level of inflation. What it tells instead is that to lower inflation to the same degree in a stagflation environment will cost more sacrifice from unemployment. So this is the trade-off. The thing is that now that the Fed is going to be willing to act on inflation, they will cause much severe damage to the unemployment rate than they would do in a normal environment. They will have to suffer the double consequences of it. And this is what we've seen. Unemployment is a major factor in our stagflation mechanics. So as the Fed is trying to pull out of inflation, they will rise against unemployment, which will weaken demand and therefore limit the output growth of the economy. So by trying to pull out inflation, the Fed is actually reducing the capacity of going out of stagflation. And this is one thing that you really need to understand. The situation we're in now is very well described by that. If we sum up all of this information, it tells us just one thing. We have entered stagflation and the probabilities to reverse course are close to zero. The best we can do now is trying to oscillate in stagflation by trying to avoid getting into the extreme areas. So it's kind of trying to play this weird stuff that some people call the soft landing in that perspective in which we're trying to limit inflation. We're not going to reverse course. We're going to try limiting inflation without trying to push too much pressure on the economic output in the economy, because we're going to weaken. It's for sure. The next step is to start weakening the unemployment numbers, and in that perspective, starting to do this will inevitably have an effect on demand and on the GDP. So we need to make sure those levels are sacrificed a bit, yes, but not necessarily entering the recessive loop, because if we terminate the inflation pressures on the economical behaviors in order to create recessive feedback loops, then it is a losing game anyway. So the thing is that we need to balance these two forces correctly. And this is the problem the Fed currently has. Because if you understand it all, the trade-off is already loosening the action of the Fed. So everyone is paying too much attention to the Fed. The Fed will probably do whatever it can, but the Fed just can't solve that problem. So you have to understand that we're in stagflation and we're here probably for at least a couple of years. Because the solution out of inflation comes from the fact that in order to retrieve a growing economy, we need to stop pressuring unemployment and demand. Though in order to stop weakening unemployment and demand, we need to stop trying to combat inflation. So the thing is that the only way out of this is by reducing the inflationary pressure that caused the system to enter that stage in the first places. Though what we are talking about is trying to get the hell out away from supply shocks and the multifactorial reasons that put us into this inflation environment. Certainly not just financial printing from the central banks. It's much more complex than that. There are multiple factors, and supply shock are just one another of them, just not the single one either, okay? So we need to solve a multifactorial equation that is leading us into this current inflation systematics. What the Fed has to fight immediately is the fact that if they don't fight it, we might have the economic behavior that starts to create negative feedback loops on inflation itself, which will automatically fuel inflationary pressure in the future, which will make the job even harder because there is going to have to be paying even more on the negative trade-off there is on employment. So yes, the Fed had to act preemptively, and they definitely had no choice about that. But the thing is that they're lost anyway. There's too much attention on the Fed now, like it is the savior. It is not. The thing is that we're in stagflation for a couple of years at best. The best we can get is to hope the Fed will perform an as soft landing as possible, but this is not going to happen. The soft landing isn't possible. We will probably be stuck with a close to zero recessive kind of environment, but we're going to try doing as much as we can to try not having to fight two wars in a single place. We're already fighting the inflation war. Do you really think the Fed is willing to sacrifice the growth to have two problems to fight in the same time, with acknowledging that they have absolutely no way into getting out of sacrificing the Phillips curve's trade-offs? So the Fed is not the actor right now. Time is the only thing that will pull us out of stagflation. And in the meantime, the Fed can only try to avoid having the negative effects to come on top of each other and to pile up into pushing us into this very weird and crisis environment. We know that 1970s failed to this, and we got up to 25 and above levels of inflation. We're far off from these levels today. And people try to forecast we'll be there. It's a big problem to me. The second thing is that there's a model regarding recession, a model that I've been following for years and still follow as today. It is a model, it can be wrong, but the thing is that I've always looked at the way the 10-year yields are behaving against the Fed funds rate. And anytime you see the 10-year yields crossing down the Fed funds rate, that means we are entering into clear, immediate recessions. So the thing is that currently we're not. As we can see, we're not in a recession. We're in a technical recession because GDP has crossed below zero, GDP growth. But the thing is that we still have a very solid environment in terms of employment. This doesn't come along with a recessive negative feedback loop. We're not yet there. As we can see, employment is very high right now in the US. So in that perspective, we're not in recessive territory. We just have negative growth. So we have early signs of contraction in our XY axis model, but we're not yet there in recession. In order to terminate this, we need to see this crossing down, just like it did in 2008, 2000, and so on. Every recession has always been priced in that way. So that's the reason why I pay a lot of attention to this. If this crosses down, that means the bond market investors who don't play games and gamble, if they start to cross down that level, then that means they're pricing in the recession, a durable recession as well. In that perspective, yes, we will have a dual problem to deal with, inflation and recessive economical behaviors. Right now, we have only one of these two. So pay attention to this. We are in a stagflation economical behavior type of context, though don't try to use any other model that is totally aside from these. That doesn't mean we're headed into the 1970s. That just means the underlying mechanics and pressure of stagflation are the ones we need to be worried about. We can maintain a moderate stagflation environment for long enough, as long as we can play that soft landing game correctly. If we fail to do this, then we have to combat a dual problem, recessive behaviors and inflation. And as we can see, the Fed is going to be pretty much inactive as doing that job, because the trade-off they have in a stagflation environment is very much not helping to that issue. So stop complaining about the Fed. Yes, the Fed is important, but the solution doesn't come from them. They might help not getting to extreme territory, but that's all they can do. They can't solve the stagflation problem. We're in there for a couple of years, okay? But if you think that this is negative for stocks, then this is a big problem, because it turns out it is not. If we have a look at the S&P 500, for example, in the example and the context of those 1970s, which is an extreme crisis, then what we can see, look at what it does to the stock market. Is it crashing like 2008? No, it's not. It's pure flat return. So we'll do an eventually separate video on how to speculate and how to behave on stagflation environments, but we're going to keep it that way for today. It's 25 minutes into that video. At least now you know everything there is to know about the stagflation environment. The Phillips curve shifting is the core element of that equation to understand that the Fed is going to be the weakest link in that equation. All that Fed can do is avoid extreme stagflation environment, but they are going to have to suffer a huge and dangerous trade-off, which means if the recession is entering its negative feedback loop mechanic, that means the Fed will immediately have to stop combat inflation, and they're going to have to fight two wars at the same time. So right now, the Fed must do everything they can to try avoiding the recessive behavior being at play. And that's the reason why my model says, look at the fucking 10-year yield as long as we can, because as long as it doesn't cross down the Fed funds rate, we only have one war to fight. And it's always making things easier is not to trigger another one. So if you think the Fed doesn't know that, like I said, the Fed might be talking a lot, but professionals know they can't do much about it. So be real cautious with that. The environment we're knowing and experiencing today is nothing close to the 1970s, but the background mechanics of it are already potentially at play. At least half of that equation is already at play, and the last and remaining information is we're not in stagflation, we're in moderate stagflation, meaning that we're in an environment in which the risks come from stagflation type of behaviors, not recessive and depressive type of things. Totally nothing compared to 2018, to 2008. The background mechanical behaviors are absolutely not the same, and you must not want to mix up the two. So that's it for today. Bye-bye.